Hello, and welcome to our 2024 Chartered Accountants Worldwide Network USA Beyond Accounting online presentation. I'm David Powell of Chartered Accountants Worldwide Network USA, and for today's event, we're partnering with Chartered Accountants Australia and New Zealand. I'm in Boston, Massachusetts, and joining me for our first session is Charlotte Yvette from Australia and New Zealand, based in Wellington, New Zealand, and Sid Chitness in Los Angeles, California. Note, this is a 90-minute presentation with 2 sessions. Some of our correspondents sent out when you registered indicated this was a 60-minute session. It is a 90-minute session, and the first session, including this introduction, runs for about 30 minutes. Charlotte will introduce the paper which CANZ and ACCA have recently launched. Sid will then give his perspective on sustainability in mergers and acquisitions and how it relates to his own role within his organization. We will then be joined by a third panelist, Sean Goebel, based in New York. In addition, we have our moderator join, Jason Poulton, a CANZ member and a CFO with Commonwealth Bank of Australia, also based in New York. Jason will moderate a panel session for 40 minutes about the event with our speakers and then move on to do audience questions for the remaining 15 to 20 minutes. He may also jumble those 2 up along the way, depending on how the event is going and what questions are coming in. In joining this event, you will have been prompted to sign into Slido. This is an app we are using to do Q&A and polls. We will also use details of those who sign in to send out digital badges you can add to your LinkedIn profile if you so choose. You can also reference the badge and attending this event as part of your own CPD activity. And you will also see a control panel located at the top right of your screen if you're on a laptop, or the bottom of the screen on a mobile device. The panel has tabs for Q&A and polls, and you can enter questions under the Q&A tab. And if you see someone ask a question you like, if you like the question, it raises it up the list we're looking at. And in session 2, Jason will be monitoring this list in deciding what questions to ask our presenters. During the event, we'll be asking 5 polling questions with yes/no answers, and we'll give you about 20 seconds to answer. If you have any issue with answering the polls, log a comment under Q&A so we can timestamp your participation. For those of you that are US CPAs and have requested CPE credits, answering the polling questions is a requirement to evidence you have attended the event. At the end of the event, as you exit, you will also receive a short survey. We appreciate your feedback and let us know how we did. Do note that the CPE certificates of the members who are also US CPAs, and I will be sending these out to members who qualify and are based in the United States within 2 weeks of the event. If you are also a US CPA and located outside the USA, then email me after the event and I will follow up with you directly. As mentioned, all attendees will be sent a digital badge within 10 days of the event. So to kick things off, let's do our first polling question. Polling question 1. Do sustainability-related issues matter in the mergers and acquisitions transaction workflow? And the answer is yes or no. So please answer that question. And while you're doing that, let me introduce our first speaker based in New Zealand, Charlotte Yvette. Charlotte is a chartered accountant and has worked in the financial services, energy and public practice sectors in New Zealand, the US and the UK. Charlotte contributes to Chartered Accountant Australia and New Zealand's thought leadership initiatives on a wide range of emerging trends ranging from AI, ethics and the future of finance to blockchain technology. Charlotte also leads CANZ's member engagement and DEI teams in New Zealand. She is also responsible for advocating in the public interest with the New Zealand regulators and government on policy issues relevant to chartered accountants and the accounting profession. She is also co-author of the new Sustainability in Transactions research paper, which is produced by CANZ and ACCA. It examines where sustainability meets corporate acquisition and divestment activities, and Charlotte will provide a brief overview of the research that informed the paper and its findings. And now let's look at the results of the poll. Ian, can you share them? And it looks like yes is the answer with 97%. And now, Charlotte, over to you.
Look, thank you, David, for that very warm welcome. And it's truly a pleasure to be here this morning in New Zealand, this evening in the US, or wherever other parts of the day or night, wherever else you're based in the world, on this truly global panel. So thank you for having me. Look, over the next 15 minutes, I'm going to provide a brief overview and some of the highlights from Chartered Accountants ANZ, which I'm going to abbreviate to CANZ. Otherwise, I'll use all my 15 minutes just saying that. Our recently published paper that we did jointly with ACCA. So this paper is called Sustainability in Transactions. So why is the topic important? Well, sustainability is basically on the agenda of every boardroom at the moment. And also transaction flows are significantly growing. So I think I've got some statistics that are a little bit old, and it's probably increased since then. But since 2022 alone, the value of M&A transactions globally was estimated at $3.2 trillion US. So that's a lot of money. So sustainability matters. Transactions are a big deal. And why are we here today? Well, this sits firmly in the domain of many and most CFOs and their teams. So in the paper, we explore the sustainability considerations that should be borne in mind when undertaking M&A activity. So how did we do this? We used insights gathered from a variety of global roundtables, and then we did 50 or about 50 interviews with many thought leaders and practitioners across the accounting and finance profession globally. So this is truly in a globally informed paper. So what we did find in this paper, we identified several steps that accounting and finance professionals, such as yourselves, should consider when considering the interplay between sustainability and financial due diligence. So just on to the next slide, looking at the agenda today. Firstly, I'm going to take you through the interaction between sustainability and the transaction process and why it's important, and I've just touched on that. Next, we'll look at the applicable sustainability considerations within the due diligence process itself. And finally, we're going to conclude, like all good papers should, with some actions and recommendations to consider specifically as accounting and finance professionals. So if we just go through to the next slide, I'm going to start with the transaction process itself, as I indicated, and the overlay of sustainability. So I guess first, looking at the definition on the slide there, it's really important to get a shared understanding of what's actually meant by sustainability and the connection to ESG. So that's environmental, social, and governance factors. So as you can see on the slide, sustainability, and for this report, the purposes of this report, it refers to the long-term value creation by organizations and addressing three interrelated domains. So that's the environmental, the social, and the economic. So this is the transactions that organizations not even should, but must navigate now and then in the coming years as well. So I guess ESG, in contrast, focuses on evaluating the performance of organizations based on those three specific factors, the E, the S, and the G, whereas we can think of sustainability as a broader principle that encompasses responsible and ethical business practice in a more holistic manner. So whilst a lot of the conversation might imply an interchangeability between the two, they're not necessarily the same, in that ESG can be considered a subset, I guess you could say, of sustainability. So in the investment space, there's a considerable focus on the credentials of the funds themselves and how they address their sustainability goals. So this is something I'll come back to shortly. But if you can see in the diagram there, around the E, the S, and the G, you've got a layer of governance, which is especially important. Okay, now on to the next slide here. We need to establish why it matters. And I think, I sort of said at the outset, the transaction flows are in the trillions and growing. So, and also, why does the interplay between sustainability and the transaction flow matter? Well, we've got a couple of quotes on the slide there from participants who contributed to the research. Both are underpinned by a first essential point as to why sustainability needs to be considered in the transaction process, which is because it's an essential part of how organizations must develop now and into the future. It's no longer a nice to have, it's an essential process, and it needs to be woven into everything that we do and the way we view organizations and transactions. So to ignore it would be to fail to consider one of the greatest threats to the long-term viability of an organization, which is that it creates returns, it grows value. Now, the second quote, the bottom quote there, emphasizes the need to move this discussion forward from a checklist approach. And this is something we certainly found was more developed in some markets than others around the world. I'll touch on that in a bit. So questions like, do you have a sustainability plan? Has a qualitative assessment been undertaken of how robust that plan is? So sustainability becomes fundamental question to be addressed in the minds of the inquirer or the investor. Does the acquisition or investment alter their own sustainability profile? So that's a big question mark. So our research, as I said before, highlighted some significant differences in the nature of the business case for sustainability across different markets. So there were certainly different levels of maturity. And as a general rule, the impetus seemed to be greater in the global north than the global south, for example. There's more detail about that in the report if you want to dig into it. Things like the maturity of regulation, stakeholder influence, they may be a factor in this, but my thoughts are that as this conversation continues to develop, the relevance across all locations will only increase. So just something to think about there as we move on to the next slide. So this slide shows there are 4 key factors that are driving the increased relevance of sustainability in the transaction process. If you were to put them into 4 buckets, the first would be the role of financial institutions. So the role of regulation and stakeholder, I guess you could call it peer pressure. Many financial institutions are looking to their investments to contribute to their own sustainability goals and, enhance their own sustainability profile. So several of our roundtable participants commented that in their own experience with both banks and private equity investors, they were seeking information on this agenda as part of the transaction or investment process. So, it's increasingly common. This also cascades into strategic investments where one organisation acquires another or disposes as part of its operations. So that's the first. The second, as shown on the slide there, increasing the transparency in supply chains around the sustainability agenda. So if you consider an organisation with a global supply chain, either seeking investment or perhaps making a strategic acquisition, the long-term viability of the supply chain, so whether there are any ethical issues with it, can cause significant considerations. So exploited labour, the vulnerability of key installations to climate change can and will impact the viability of the transaction. Organisations ignore these things at their peril. They cannot afford to ignore them. The third driver we've got there, which I'll touch on, is regulation. So whether this is through the implementation of CSRD or ISSB standards or similar, the potential for disclosure risk significantly increases. Does the acquired organisation have the data and the processes, for example, in place to address these requirements? What's the impact on investors of the combined entities profile? Just some of the considerations there. And finally, the fourth factor on the slide in front of you is customer sentiment. So an organisation only largely exists to deliver values to its customers. If customers are alienated by the organisation's progress on the sustainability front, then the value of future revenue streams falls. Customer sentiment matters, and I don't think I need to tell you that. Right, now moving on to the next slide, if we have a look there at the transaction workflow. So again, I'll just touch on this lightly, but sustainability, as I'm sure you're all aware, is an end-to-end process. It's an end-to-end factor in the workflow. So it needs to be, as I've said before, woven throughout. So this slide details some of the potential impacts either from the buyer perspective, which are in red, or the seller perspective, which are in blue. So throughout that entire workflow. Whilst it's shown here as a linear model, not too many options on a slide, so it's shown as a linear model. The reality is that in many transactions, various phases might be repeated as information is discovered and evaluated. For example, discoveries and due diligence can impact the valuation and negotiations. So it's linear there, but obviously in reality slightly different. In the interest of time, I'm not going to delve into each phase today, but if there's anything of interest to you, I really encourage you to go onto the CA ANZ website, download the report and read the commentary in detail, which goes into each of the phases in a lot more detail than I will here. But I will, if I may, take a moment to highlight some of the key considerations, starting with those initial 3 phases. So starting with strategic and going up to target screening, there are a couple of considerations I would like you to think about. Firstly, an alignment of sustainability appetites is essential. And I've mentioned this before. So what is the level of related risk that the acquirer is willing to take on? Does it match, improve, or denude the acquirer's existing profile? So, that's a very key consideration there. Secondly, do those making the decisions, for example, the investment committees, do they actually have the appropriate skills to analyze and interpret this information? And that's a very real consideration. Several roundtable participants we interviewed when forming the research for this report questioned whether the skill development would benefit these groups. So that's a nice way of saying, said that they could potentially, there's a need for them to upskill. So would they, for example, be able to recognise greenwashing and the implications of it, and many other considerations there too. And I'm going to come back to this for our profession in accounting, but this sort of applies across the board. Sustainability is actually a very technical area. It's not a soft, waffly area. It's a technical area akin to tax, akin to financial reporting, audit. So you need to have technical skills and able to be able to do it justice. So being up to date with skills and expertise, as well as that sort of broader sustainability landscape, is key, not just for our profession, but across a range of professions. But I'll touch on this a few times in the presentation. So I guess just to bring this slide to a close, the nature of this initial assessment, so in those first 3 steps, may impact the capital that's available to finance the transaction, which is incredibly important. So cost of capital is increasingly impacted by the green credentials of an organisation. So it's becoming more and more key in a real dollars and cents kind of a way. Moving on to the next slide now, which I'm just going to briefly touch on. The report, we did not consider in detail how sustainability impacts the valuation model. IVSC incorporate ESG considerations into their revised valuation guidelines, which I believe is effective from 31 Jan 2025. Early adoptions allowed for those who are super keen. And there's an appendix to IVS 104 on data and inputs, which has specific guidance on ESG considerations and valuations if you're interested. But what I will touch on is there are 2 potential models for valuing an organisation, either discounted cash flow model, which considers future revenue streams and is underpinned by a series of assumptions, which is where sustainability has a big impact. And the second is a direct comparison between similar organisations. If we go to the first approach, though, investment in sustainability, either as capital or operating costs, must be factored into the model. It will also increase the range of uncertainties under which an organisation operates, such that the sensitivity analysis must include sustainability variables. What level of certainty or uncertainty is there around the impact of climate change, for example? The potential impact of, for example, say on sunset industries could and will be significant. So sustainability can impact the cost of capital, as I said earlier, and hence the underlying discount rates applied in the model. So another question, to what extent can any future liabilities be factored into the model? So sustainability is a significant consideration in valuation, and there is a little bit more information in the report on that if you care to have a look. Right, so moving on, I guess, so once the potential transaction has passed the initial phase of the workflow, the focus moves on to the more investigative phase or due diligence. So what's the interrelationship between sustainability and financial due diligence? And as we look at the next slide, I guess I'll take a step back. I'm sure you're all very aware, but just to be clear, financial due diligence is the process of thoroughly examining a company's financial records and performance to assess its, I guess you could say, health and value before making a business decision like an investment or an acquisition. So, that's really going through and peeling back the covers and having a look at what's under the hood from a financial point of view. So there are various forms of due diligence, and identifying which are relevant for the particular transaction being considered is important, of course. However, whichever form of due diligence is undertaken, sustainability is a thread that impacts them all. It's a common thread. So whether or not a separate sustainability due diligence exercise is undertaken or not, the scope of any work undertaken must address the relevant sustainability-related risks and opportunities. And notice I mention opportunities there as well as risks, because there are upsides and downsides that need to be considered. So whilst for some other forms of due diligence, it's possible to align the due diligence approach, global standards don't currently exist for financial due diligence, meaning, as commented on by some practitioners in the roundtable interviews, sustainability work in due diligence may take the form of a more limited scope review than a full due diligence assessment. As an acquirer or an investor, if reliance is going to be placed on such work, it's important to scope the work completely at the outset so that it specifically addresses the risks and requirements. The same, I guess, with any piece of work that you undertake. Scoping it out at the beginning saves a lot of time in the back end. Now, moving on to the next slide. I guess this shows really what a broad number of issues is covered off by sustainability. If you look at the slide on the right-hand side of the diagram on the right-hand side of the screen there. Therefore, scoping any due diligence work can't just be about one dimension, because the data might be easier to obtain or the concepts easy to understood. So I guess that's the bias towards what you know. It needs to be holistic and encapsulate all of the relevant aspects of sustainability. So the diagram shown on the screen in front of you gives examples of the factors of relevance in conducting sustainability-related due diligence across the 5 different dimensions we've identified of sustainability. There's a more comprehensive list in our report if you're interested, again, which is on the CA ANZ website. So the factors to consider range from strategic, such as the appropriateness of the sustainability strategy, right through to the more tactical, such as, for example, emissions data. So it's the nature of the due diligence process to draw these threads together and pull it into what I would describe as a cohesive picture. So in developing that picture, it may be appropriate, depending on the risk profile, to use specialist expertise. And that goes back to my point earlier about, and the same as any other technical area, the code of ethics and the fundamental principles apply to sustainability work as they do to any other piece of work. So professional competence and due care is the one that comes to mind here. If you do not have the necessary technical expertise, then it is appropriate to engage an expert to assist you with that work. Right, as we move on to the next slide, this is the final part of the report, and I guess the punch part of the report, where we consider, and I'll run over them now, some of the recommendations and actions presented in the report. And if anything tweaks your interest, because I will just touch on them, then please dive into the report on our website. We also, for those of you that can't quite face reading a 60-page report, there are summaries, there's a podcast, there are checklists, there are all sorts of different types of material that you can engage with, some of them more accessible than others. But the report recommends 5 key actions to ensure sustainability considerations are considered in transactions. The starting point depends on the strategic objectives, as with anything, of both the acquirer and the acquirer and the acquiree. So it's really important to align those sustainability objectives, and you really need a risk-based approach there. So secondly, and as I've said a number of times now, and I cannot emphasize enough, sustainability-related due diligence needs to be integrated into the overall approach to the transaction. It's not just a bolt-on, standalone process. It's integral to the future of the organisation and needs to be treated as such. Thirdly, there needs to be operational rigour, and I'm sure as fellow chartered accountants of various professional bodies, you will be all on board with that. So operational rigour is essential in relation to the achievement of the sustainability objectives. So also recognising that sustainability presents not just risks, but also significant opportunities. Thirdly, I did say rigour, but I guess you also need to appreciate that the sustainability agenda, say that 5 times quickly without tongue tie, The sustainability agenda, it has to be agile and flexible as our level of understanding of the sustainability objectives changes and evolves throughout the due diligence process. And as I guess at a higher level, the regulatory environment evolves. So yes, we need rigor, but we also need to be agile and flexible. This is another point that I will keep coming back to. You've heard me say already, sustainability related issues are technical and they must be addressed by those with relevant expertise. The fundamental principle in the Code of Ethics of professional competence and due care continues to apply to sustainability work as it does to every other technical area of accounting. So this is where upskilling and continuing to stay on top of technical areas such as to sustainability and other areas as they develop in our profession is increasingly important. And then finally, any issues identified need to be framed as actionable observations. So transactions may fail because of sustainability. They may fail or may not fail because of sustainability issues themselves, but they might also fail from a lack of understanding of their implications and how their risks can be addressed in a post-closure process. So actionable observations are key. Right, moving on to the next slide here, and that's just about the role of the accounting and finance professional, which is significant, as I mentioned at the start. So becoming skilled in the appropriate areas is a key action for the accounting and financial professionals, such as yourselves. So as the quote that's shown on the slide here from an Australian Roundtable participant indicates, there is a clear role for members of our profession to play in this process. And I also think, and we'll touch on this in the panel discussion, that sustainability as a topic for our profession is going to play a key role in attracting future talent at a time when we're actually struggling to make the profession an attractive place. So it also has a key role to play in the attractiveness of the profession. Many of the discussions around the impact of sustainability-related issues and the opportunities require an evaluation which can be drawn from both qualitative and quantitative data sources. So, both are our domains now. It can often be open to interpretation as well. So it's not, as I'm sure I don't need to tell you, it's not just about the financial impact, it's about organizational risk more broadly. Moving on to the next slide now. Again, focused on expertise. Developing the relevant expertise is an important aspect of the conversation. It's essential. There are two areas of expertise that you may choose to develop, although I would recommend both. Number one is just that sort of in the broadest sense, the appreciation of sustainability itself. So, for example, at Chartered Accountants ANZ, as with many other professional bodies such as ACCA, we offer a myriad of sustainability-focused learning opportunities that help support members to enable an insight into sustainability from a perspective of an accounting and finance professional. For example, we have a range of online sustainability micro-credentials and micro-courses on essentials, on sustainability reporting, I think also on assurance as well. So, and your own professional body undoubtedly will have the same. But the second, as I mentioned before, is the actual transaction process itself, which is the technical aspect, where bodies such as the IMAA, for example, whom I think ACCA have a partnership with, so you can get discounted access if you're an ACCA member. So there are other bodies such as the PRI, Invest Europe, GRI, ESMA, who offer programs and insight material. So, I really encourage you to have a look and upskill your sustainability knowledge. It's not, look, I just think as a profession, you actually can't afford not to, as an individual in our profession. Just for a wrap up from me today, I would say if you're interested in exploring anything that I've covered today in more detail, please feel free to get in touch with me directly. Otherwise, jump onto the Chartered Accountants ANZ website, download the report, listen to the podcast, have a look at the various summaries or tables. There's a wealth of information on there. But I do encourage you to stay abreast of this area. Your willingness to be on this webinar today shows obviously that you have an interest in lifelong learning, but stay over this area and upskill yourself, because we can't afford as a profession not to. And David, back to you. Thanks.
Thank you, Charlotte. And I see a question coming in about, can we get a copy of the presentation? you will be able to. What we will do is we're recording this webinar, and once it's been edited and approved, we'll be posting it on our website and the Chartered Accountants Worldwide website, and we'll also attach PDFs of the presentations there. And now it's time for our second poll. So the second poll is, do you believe that sustainability considerations are now central to strategic intent and valuation in transactions? And the answers are either yes or no. And while you're responding, let me introduce our next speaker, Sid Chitnis. Sid is Managing Director, Partner, M&A Advisory with HCVT in Los Angeles. Prior to this, Sid spent just under 7 years with Julian Loki, initially in New York, then Los Angeles, where he was a member of the Financial and Valuation Advisory practice, which provides valuations and transactions advice to its clients. He qualified as a chartered accountant with Deloitte in Sydney, Australia. Sid is also a chartered financial analyst with Chartered Accountants Network USA. Sid is a voting board member and runs our West Coast and Midwest chapters. So let's look at the results of the poll. Ian, if you can bring those up, it looks like 89% are saying yes. And with that, Sid, I will pass to you.
All right. Thank you, David. Hi, everyone. My name is Sid Chitnis. I am a partner leading the M&A advisory practice at HCVT. And prior to joining HCVT, I was at Houlihan, Loki, and Deloitte. And again, it's a pleasure to be here across these multiple time zones. And what I wanted to share with you today was some trends for ESG, but within a private equity framework. So I might just kick this off with a quick background to HCVT, give you a little bit of context as to my role, and then we can get into kind of the ESG and private equity trends. So HCVT is a top 30 CPA firm in the country, largest in Los Angeles. We have over 800 staff, 100 partner principals, spreading 13 offices. We specialize in tax, audit, business management, and advisory services. Predominantly, it's to private equity and their portfolio companies, family-owned companies, and high net worth individuals. We've recently expanded our advisory services in 3 areas. So it's M&A advisory, valuation, and CFO services. We have advised on over 700 deals over the last 4 years, and we'll continue to advise on these types of deals across the full deal lifecycle. So what Charlotte showed the roadmap of kind of the deal lifecycle and sustainability. Essentially, that's what we're covering in our service line at HCVT. So my slides aren't as pretty as Charlotte's, but you've probably noticed that ESG has become a massive talking point in the PE world lately. It's gone from a niche concern to a major strategic priority in just a few years, right? So today we'll dig into the numbers behind the shift, explore the key drivers, and look at what it all means for PE firms and investors. So let's kick things off. A quick pulse check on the PE market. Global private equity, let's call it assets under management, is over 7 trillion currently, which is huge. It's more than doubled over the last decade. Despite crazy economic ups and downs, PE firms are sitting on a record amount of dry powder. So that's the money that they've raised, but haven't invested yet. We're talking 2.6 trillion as of Q4 2023. So that's what's just sitting on the sidelines that has been invested. The big US firms are holding a big chunk of that cash. But here's the catch. So even with all that money burning a hole in their pockets, PE firms are finding it hard to close deals still. There's high interest rates, tougher regulations, and potential recession threats, right? One would like to not think about it, but those are threats that are in the market. So buyout activity actually fell by nearly half in 2023 compared to 22. And so with some of these concerns, I think this is where ESG comes in. Faced with hyper-competitive deal market and intense pressure to deploy capital, more and more PE firms are turning to ESG as a way to stand out from the crowd and drive value creation. Let's go to the next slide. So here I wanted to talk a little bit on the evolution of ESG in private equity. Yeah, look, things have changed pretty quickly on the ESG front. Just a few years ago, most PE firms were content to check a few boxes on LP questionnaires. I think Charlotte had mentioned that in her presentations. So fast forward to now, ESG has become a core part of how many firms invest and operate. The numbers tell the story, right? So 9 out of 10 LPs, limited partners, which are the investors that invest in the PE funds, they now factor ESG into their investment process. And over 3/4 use it to pick which managers they'll back. Meanwhile, almost 3/4 of PE firms are routinely screening for ESG risks and opportunities during due diligence. And a bit of a concerning aspect is more than half have actually walked away from deals over ESG concerns. So that's a big shift from where we were, let's say, a decade ago. Assets in dedicated ESG and impact funds have skyrocketed. So we're talking a jump from, I think, 6 billion to nearly 150 billion in just 5 years. And this is just before COVID. That number has even grown substantially since then. In recent years, buyout plays such as TPG, KKR, General Atlantic, Bain Capital, they've raised multi-billion-dollar funds dedicated to impact and ESG-focused funds. So I guess what's the big takeaway, right? So ESG has gone, I think, mainstream in PE. Still a long way to go, but I think it's here to stay. The top firms are staking out leadership positions. So if you're not on board, there's a risk of being left behind. So it is led by the top funded firms. But at the end of the day, I think all private equity needs to think through this. In this slide, I wanted to just cover kind of drivers of the ESG shift in private equity. So I mean, what's driving this surge, right? For starters, there's growing evidence that strong ESG performance goes hand in hand with better financial results. PE firms with their hands-on ownership model are in a great spot to drive positive ESG changes that can boost the bottom line. LPs are also putting major pressure on managers to up their ESG game. So a majority of them now use ESG metrics to decide where to put their money. And almost as many are pushing GPs, so the general partners, these are the people that are making the investments, to invest in ESG, even if it dings short-term returns. So that to me just shows the level of concern and the level of rigor around how to select a fund based on ESG. Another notable shift has been longer holding periods, right? So where portfolio companies were once held for an average of 3 to 5 years, that horizon has extended to 5 to 7, even sometimes 10 years. This provides a longer runway, right, to enact strategic operational improvements and then drive growth ultimately. It's against this backdrop, I think, of intense competition, a longer-term value creation, ESG has emerged as a critical priority for the private equity world. There's also the fact that regulators and broader society are demanding way more action and transparency on sustainability. From the EU's new disclosure rules to the proposed SEC climate reporting mandates, the bar is rising fast on ESG. Taking ESG seriously is becoming a must-have to stay competitive in PE. So dropping the ball on this is going to come with some pretty big risk. What are some of the opportunities? So for PE firms that go all in on ESG, and that doesn't mean that you just have to invest in ESG or impact type investments. It's on a holistic basis. The potential upside is huge, right? On the fundraising front, LPs are throwing money at managers with credible sustainability mandates. ESG-focused PE assets are expected to more than triple by 2026. That's expected to hit a staggering 11 trillion. During the deal process, an ESG lens can help PE firms spot hidden gems that often others might overlook. We're talking companies with untapped sustainability potential that could be superstars with the right backing. Leaders can also use their ESG credibility to beat out rivals in bidding wars and score, let's call it off-market or proprietary deals. Things like, cutting carbon emissions, upskilling workers, boosting diversity, and tightening up governance are just some of the improvements that a private equity firm can bring to the table. They can create businesses, clearly that's going to create businesses that are more valuable and resilient for the long haul. So I think, like, to sum up, right, you have longer time horizons, you have credibility in the market, you're going to get deals that are off market or proprietary, and that's just going to drive longer term value. This is going to set them up. The grand finale at the end of the day is the exit, right? So the PE firms that can tell a compelling ESG story with the data to back it up are well positioned to command top dollar from sustainability minded buyers, and that's only going to increase as time goes on. And the PE shops are now calling it the ESG premium, and I think that's very true, and that's going to keep increasing. Last but not least, PE firms can ride the big waves propelling sustainable products, right? Things like just your standard renewable energy, your green real estate, upcycling products, and plant-based foods, to name a few, right? So these are these up-and-coming themes that have, over the last couple of decades have come up. Now private equity are looking at this, right? So I think PE firms with the deep pockets, the amount of scale that they can get with all the investors coming on board is going to impact it in a big way. So some of the risks, right? So like I've talked about opportunities here, but on the flip side, all to this is PE firms that drag their feet on ESG are staring down some serious risks, right? So the starters portfolio companies with weak ESG profiles are sitting ducks for all kinds of financial and operational headaches. We're talking things like getting hit with a carbon tax, or running out of water, or losing key customers, being fined, right? Another risk is greenwashing, right? Is another big danger. With ESG standards and disclosure rules getting tougher by the day, PE firms can't get away with making vague promises anymore. Those that, let's talk a big game on ESG without walking the walk, they're just going to have, again, nasty fines, lawsuits, and then lastly, reputational damage. Over time, fundraising, gulf between ESG leaders and laggards is only going to widen. LPs have been crystal clear, right? They're going to vote with their dollars. And, within portfolios, companies that drop the ball on ESG might need costly cleanup jobs that eat fund returns. The worst case, they could be flat out unsellable down the line, which is, not to be in a situation that you want to be in, right? Most of all, PE firms that treat ESG as separate from their core strategy are then leaving a ton of value on the table. The evidence keeps piling up that ESG leadership and financial outperformance are one and the same thing. You can't really have one without the other now. So, and look, to wrap things up, ESG has it's gone from 0 to 100 in the PE world very quickly. This is way more than a passing fad. It's a fundamental rewiring of how industry defines and creates value in this PE world, right? So PE firms are willing to step up and lead. They're going to have access to deep pools of capital. They're going to be able to score these off-market deals. They're going to be able to build stronger and more valuable companies. And then at the end of the day, they get the grand finale, which is the exit. And I think, as a whole, the world should be in a better place if you created that value. So that's it for me. So thank you very much. And back to you, David.
Thank you, Sid. So it's time for our third poll. Polling question number 3. And that is, are you personally involved with M&A activity within your company? And the answer is either yes or no. While that's happening, let me introduce our new panelist, Tashan Goebel. Tashan Gobel is ESG and Sustainability Controller at S&P Global, where he helps shape the company's green equity story and contributes to the company's leadership in corporate responsibility. S&P Global has a unique ability to deliver the right data, insights, and intelligence that customers seek so they can make informed decisions with conviction. With over a decade of experience, primarily at KPMG as a director and ESG leader, Tashan provided innovative business solutions through audit, sustainability, and advisory services to several Fortune 500 companies. Tashan is a chartered accountant and earned sustainability leadership credentials from Harvard University, NYU Stern Center of Sustainable Business, and the University of Cambridge. Tashan has extensive international experience, having worked in offices throughout Australia, Europe, and the United States. He also actively contributes to humanitarian causes as a board member for various organizations globally. Next, let's introduce our moderator, Jason Poulton. Jason is CFO USA with Commonwealth Bank of Australia, Americas, based in New York. Having worked in public practice with BDO in Melbourne, he has spent much of his professional career internationally in financial services, with roles at MF Global and CBA in London, before relocating to New York. He is registered with the Financial Industry Regulatory Authority, FINRA, as a financial and operations principal, and holds a Bachelor of Commerce majoring in accounting and business law. Jason is a Fellow of Chartered Accountants Australia and New Zealand and is on the CANZ Council representing Rest of the World members. He has held various positions on committees and advisory bodies, including Educational Team Leader on the UK Overseas Member Committee and as the New York Tri-State Link Member Representative. With CAW Network USA, Jason is a voting board member and our representative with CANZ. Now let's review the results of the poll. And while you're doing that, I'll ask our first two speakers to join. And Jason, over to you.
Thank you, David. And thank you to Charlotte and Sid for those introductory presentations. Now, to move on to the panel discussion, I'm going to ask each of the panelists to provide one key message for our audience. And only fair to start with Tashan to bring him into the spotlight.
Great. Thank you, Jason. And thank you to everyone for letting me present today. One key aspect that I would love for people to understand and take away is sustainability was a function that sat in the silo. It sat in the back office, and now investors are demanding more accurate, comparable, and compatible disclosures. This information is needed for a variety of different things, including M&A transactions. So embedding sustainability into your operating model and no longer in the corner, in the back office, is what is needed to unlock value. One little piece from me. Jason, back to you.
Okay, maybe back to you, Charlotte.
Thanks, Jason. And Tashan, I couldn't agree more, actually. Like, integration is key, but I will think up my own key message over and above yours. And that would be that CFOs and their finance team, so professional accountants, have a crucial role to play in the sustainability journey, especially with transactions. So we have all the expertise in financial analysis, critical thinking. We understand the numbers and the data, both financial and non-financial. So we need to bring that all together and remember to continue upskilling to get those qualifications, if that's what you need to do, to get the practical experience so that we stay at the forefront of this very important area. And as I mentioned earlier, it's also going to be a vital tool to attract and retain future talent to the profession and help make it a really attractive career in the future.
And Sid, do you want to close out this one?
Yeah, I can. Yeah, look, both Tashan and Charlotte covered it well. So what I wanted to add is, traditionally, some people think of sustainability as, climate change or, kind of the green energy type projects. What I'd like to put out there is that, that it's not just that, right? It's also a wider kind of situation that you can look at. So for me, I think a lot of the transactions that I see focus a lot on, the social aspect, how are clients and customers dealt with, and also, the supply chain, and then your employees. So how do you treat your employees, and how do you create a company that's beneficial for your employees and the employees' families, right? So I think you have to think about the wider picture. So that would be my message, Jason.
Thank you. Okay, so we'll move into some more detail now, and I think we'll start with you, Tashan. S&P Global successfully closed a material transaction in February 22 with the acquisition of IHS Markit. Could you share your perspectives on the value that unlocks for the company from a sustainability lens?
I would love to, Jason. It's now been 2 years after S&P completed the merger with IHS Markit. And that merger really unlocked a unique collection of innovative assets and capabilities from two world-class organizations. An example of one of these combined strengths is our ESG and energy transition data analytics and services. And that was one of the revenue synergies that were communicated to investors as a part of the transaction close and identified as something that is a key priority and growth area for us. Fast forward now 2 years at the end of fiscal year 2023, we experienced strong demand for our sustainability and energy transition products and benchmark offerings and the services that we provide to the markets. Year-on-year revenue for those products increased to well over 300 million for fiscal year 23 alone for the combined company. So it's been a huge sustainability-related opportunity that's unlocked a key growth driver for the business. That's in terms of the opportunity, but in terms of our own sustainability journey, with the additional resources, expertise, and the knowledge, since transaction close, we've been able to accelerate our progress towards our sustainability-related goals. In 22, we added an additional climate-related targets. Net zero for Scope 1 and 2 by 2030, Scope 3 zero emissions from global operations with lease and sublet locations by 2035, and then also 100% renewable energy use by 2030. So we have really made some substantial progress and accelerated progress towards our goals. It's been a great opportunity for us since transaction close. Does that help, Jason? Does that answer the question?
So fair to say that was quite a successful transaction for S&P.
That's right.
Maybe Sid, do you have any examples in your organisation you could share?
Yeah, look, I think one of the things, look, we're a CPA firm, right? So when I think through it, I think one of the things that we've done or built internally is we're quite heavy on the tax side. And what we do is we help clients minimize tax. But within that, there's some strategies within, especially if you're based in the US, there are strategies that you can deploy, capital gains, you can deploy passive income into, tax effective strategies that involve renewable energy. So such as solar, wind, etc. And so I think one of the platforms that we've used within the firm is redeploying some of the capital that we've helped, save clients within these types of projects. And that's really being one, knowledgeable in the industry, two, being a connector. And then kind of on that third angle is being almost on you have to be a deal maker, right? So technically it's an M&A transaction. You're redeploying capital into more sustainable type areas. So I think that's something that we've done well. And then, you've probably heard about opportunity zones as well. So there's lots of key areas within the US that they qualify for opportunity zones. So we're one of the market leaders redeploying capital there for our clients. So back to you, Jason.
Thank you. Okay, moving on. So one of the key messages from the report is that sustainability cannot be ignored in a transaction. The reality is that organisations need to transform their operating models to become more sustainable. Perhaps Tashan, could you share an example of what this transformation might look like in practice?
Yeah, absolutely. This is not an easy question, but I'm more than happy to take it on. Fundamentally, ESG risks are financial risks. They are fundamental part of the strategic intent of the transaction and the valuation of the combined company, and it can impact the enterprise value of the organization. So how can this be ignored? We need to double click on it. We need to understand, what are these risks? How do you identify, assess, and mitigate sustainability related considerations over the short, medium, and long term? But it's not necessarily all about risks as well. There's a lot of opportunities out there as well if you embed sustainability in your operating model. To your question, practically, what does this transformation look like? One I've seen in practice was actually something that was brought about from the pandemic. Backtrack a couple of years now, and everyone was considering and looking at the disruptions in supply chain that was brought about from the pandemic. And they were looking at their supply chains in terms of, how can I build resiliency? How can I make sure that I'm able to have a competitive edge and make sure that I'm able to deliver products and services to my customers? And while companies emerged from the pandemic, they were trying to adopt different ways to look at those supply chains. And one of them was through the parallel priority with greenhouse gas emissions and looking at scope 3 emissions. So when you're looking at your offices, your locations, your sites, your business travel from greenhouse gas perspective, it didn't take long for the conversation to go down the path of, well, how can we be more efficient? How can we reduce costs and, in effect, reduce greenhouse gas emissions? How can we be more strategic and unlock a competitive edge? This is an important aspect when you're trying to construct a deal and a transaction where you're in the phase of the life cycle where you're identifying the risks. You wanted to proactively address vulnerabilities in your supply chain so you can build a combined company that is more resilient, and you're able to set up a better offering and a more successful company post-transaction close. So that's one example I've seen in practice around supply chains leading to value creation in a deal.
And Jason, I might add something there. I've seen it to Sean. I've seen it on the other side where we work with large private equity firms to mid-tier private equity firms, right? And some of these private equity firms are like, hey, we want to double down on ESG and sustainability. We just hired a chief sustainability officer, and what was quickly evident was, and I'm not going to mention any names, right? So, but what was quickly evident was, they have 20 portfolio companies, one sustainability officer, and it was very evident that this wasn't passed down, because it has to be a full culture shift of the full private equity fund and all their portfolio companies. And it's not just at the top level where you can hire someone and, I think you still need that person, but you need to take that culture and kind of embed it within the organization. So I think I saw that, and look, they're making good headway now, but at that time, that was kind of their solution, right?
Well, Sid, I guess you have to start somewhere, to your point. So, hiring one CSO is better than no CSOs, but we see this in the DEI space more broadly. Virtue signaling, I guess you could call it. You've got one person, that's great, but on their own, you talk about the 20 portfolio companies, and they're not going to be able to affect the cultural change that's required. So there really needs to be investment in organizations and funds, and need to put their money where their mouth is, so to speak.
Thank you all. I think this might be a good time just to jump to the next polling question, if we could have that one pulled up for us. The question is, do you believe sustainability risks have a material impact on the valuation of an organisation? I can see the results coming through already, which aren't too surprising, as we'd all understand. I've got 100% so far, and I'm holding it there. We've got one saying no, so we've got 4% now. But we'll keep the poll going, and I'll move on. But I think we've got a clear winner there regardless. So going back to the due diligence process in a transaction, companies are starting to consider and assess the sustainability-related risks and opportunities. What are some of the key gaps you've seen top of the agenda in the identification phase of a transaction? Perhaps Thashan, if you want to start this one.
Yeah, sure. Well, in the report that Charlotte had outlined and reference to, it indicates there's a variety of environmental, social, strategic, and economic themes that are relevant to sustainability-related due diligence. These are important aspects to think about because they're very intrinsically connected. So to answer the question, there are multiple different aspects that you would need to be considering. The one I would like to unpack and double click on is around governance. Most companies are thinking about the right governance structure today, given sustainability reporting, sustainability information, and its integration into operating models is really in its infancy. And there isn't a one size fits all because you have to consider the organization's sustainability related ambition, their maturity, and the specific regulatory considerations in their jurisdiction. But the reason I wanted to bring up governance is because also it's one of the key pillars of the TCFD, and we're finding that framework popping up in a variety of different frameworks. Now it's home sitting in the ISSB standards. It's in the SEC's referenced in the SEC's climate disclosure rule. It's in the CSRD. So governance is a really integral part. And what I wanted to bring to the people's attention is around the appropriate level of expertise that you're going to need across the transaction workflow in regards to sustainability for your target's operations, their assets, and their liabilities. So at a board level, investors are going to be expecting directors to have real experience with ESG-related matters and establishing the right structure that has the right oversight to, one, establish the right sustainability-related metrics, targets, and goals, and then secondly, measure progress to achieving those goals is going to be critical, because one key risk is you want to prevent is external stakeholders having uncertainty around the company's ability to achieve and make progress towards your set targets, your set goals. We do that today for financial reporting. So it's the same game when it comes to sustainability reporting. Don't create an indication or a loss of confidence. This can create stock price volatility. So have the corporate governance in place to set goals, manage goals, and ensure you're making progress. That's one element I wanted to bring to the attention as something that you would consider very early on in your due diligence program, and also something that people are considering today.
And perhaps Sid, in your work, you might be well placed to touch on anything there.
Yeah, I think, again, I think the biggest thing that I see out there, or the gap is the upskilling and like the either the CFO or the team itself doing the diligence. I think needs a lot more upskilling because it shouldn't be the responsibility of just the finance team. I think the CFO should be spending, or the company should be spending capital or money, right, to these areas, either one, upskilling your current workforce or like hiring people with that skill set. And then two, I might be biased here, relying on outsourced providers or third-party providers that are experts within, that industry or within that geography to do some of the diligence for you as well. Obviously, you as a company, make the final decision and obviously you need to be comfortable with all the findings, but I would rather, when I'm looking at a transaction, I'd rather have the right expert to diligence those, those aspects of the transaction than try to figure it out myself. So that's one of the gaps that we see a lot. And what that ends up happening at the back end is all about, valuation and purchase price paid, right? So, you spend the money up front to get the experts in and really do a good due diligence, right? and that's going to impact your negotiating ability on the back end of the transaction. So,
if I may, I would just add actually like governance and skills gaps are two, really good areas to focus on. They're the two that I had at the top of my mind that both Tashan and Sid had mentioned. In terms of the skills gap, there's certainly, get in experts when required, but getting an expert doesn't mean that in the finance team you can't upskill off the back of that, because you have the experts there, you can actually work with them, and skills don't come just from reading books and going on courses, unfortunately. You can't wave a magic wand. They also come from doing the doing of the work. So working with experts will help you develop and hone your skills. But as an individual, the responsibilities on you and on us as finance and accounting professionals to upskill ourselves. So even if our organisation might provide the funding and the space and the support, you actually have to lean into that and take advantage of it. And that can start by reading things of interest, broadening your understanding of sustainability. And then you can develop those sort of more technical skills by doing one of the few things that myself and other panelists have mentioned.
And obviously the first point there is to read the CA ANZ ACCA paper, of course. That might lead us
one of the
directly.
Summaries.
It leads us directly into a great question from the audience, actually, from Kelly. If an organisational management is traditional in their perspectives, how can the finance team encourage greater awareness of sustainability? And perhaps I'll direct it back to you, Charlotte.
So I guess my answer to that would be going back to my point before, like the finance team must have, awareness and knowledge themselves to begin with. So if that's not being supported by the organisation at that point in time, then that's something you can do individually off your own back. But it's just about continuously bringing those conversations to the table. So, for example, the CFO to the executive team table, you can very easily translate, as Sid and Tashan have both alluded to and specifically mentioned. So sustainability risks in their broadest sense, they're not different to any other kind of risk, and they do have financial implications. So take it back to the business case. They boil down to, dollars and cents and value creation, and that has to be at the forefront of the board and the executive team's mind. So if you use their own language, in terms of value creation for the organisation, to take it back to them, then I don't see how it could not be at the forefront of their mind.
Yeah, and I think Charlotte covered most of it. I just wanted to add, I think take a longer term view, right? Maybe there's a business case, but the business case could just be over a 10-year horizon rather than a 3-year horizon. And that changes things substantially. The returns could change substantially in that case as well. So I think as a finance team, if you can prove it out on a longer term basis, I mean, leadership should listen. The numbers are going to speak for themselves, but taking a longer term view versus, a shorter term view versus, hey, what are we doing next quarter, right? So, and obviously listed companies have that, burden on them, but I would take the longer term view.
I agree with that. I think there's so much value to be unlocked when you look at the longer term horizon. The only thing I was going to add to that was the finance team typically knows very well what is needed in terms of processes and internal controls. And this is where we need to be in terms of sustainability reporting, really building that infrastructure and that reporting architecture that we're used to in the financial reporting world, and now apply it to non-financial information. So trying to translate and be part of that conversation of helping non-financial information and those stakeholders understand what you mean by what is an internal control, what is the interval of those controls, who is the control owner, would be incredibly beneficial, I imagine. The only other element I was also going to suggest from the finance team is that typically they're well positioned to start the cross-functional collaboration. So we're finding different center of excellences being established in different organizations to help stand up sustainability reporting and sustainability related initiatives. Typically, you would have legal, risk management, you would have corporate finance, you would have corporate sustainability, and then procurement. All will have a perspective on the same topic. So to have corporate finance come in and say, hey, would someone from these departments, these divisions, these business lines, these segments want to partake in a conversation around something, like, would be very powerful. And from there, you can imagine very insightful conversations taking place. Back to you, Jason.
Great, thank you. I'm going to jump to another audience question from Shane. And I think you might have touched on it earlier, Tishan, but how strong or active is the regulatory voice re sustainability and proposed transactions in M&A?
I'm happy to take that. I think what we're finding is that sustainability reporting is trying to get at the same footing as financial reporting. And we're truly in our infancy. So I think we're seeing different regulations that are taking place. One of them is in relation to the SFDR. We can unpack that as needed if we like, but that is a regulation that was introduced by the European Commission alongside the taxonomy regulation and low carbon benchmark regulation. It really aims to bring a level playing field for financial market participants, financial advisors, and transparency, all in relation to sustainability-related risks and the consideration of adverse sustainability impacts and their investment processes. But it requires asset managers to provide prescript and standardized disclosures on how ESG factors are integrated on both entity levels and product levels. I know I'm digressing a little bit, and I'm talking about financial products here, but the regulations are coming from a variety of different ways, including transactions. But I'll pass it to Sid to maybe provide a bit more color on that.
Yeah, I mean, specifically on, regulatory, I would say it is right. It's in the infancy. And I think from my perspective, we get a lot of questions as to, hey, what requirements do we need to be meeting for this, for certain acquisitions? And these acquisitions may not be in green energy or renewables and things like that. And it might just be a basic business acquisition. And so for now, even on the diligence side, there's no requirements yet. Even on the valuation side, there's no requirements yet. I mean, they're all coming in soon. So I feel like from a regulatory perspective, everyone's aware that things are changing and people, we need to start looking out for it. But currently, it's really like, hey, are we doing anything materially wrong to get fined? Or, it's not, there's not that many proactive participants. And I think what we're going to see in the next year is more proactiveness into say, hey, like, how do we actually get better at this and meeting all the guidelines, right? So I think from my perspective, in the deals that I do, I would say the questions are coming up, but no one's being proactive about it yet. And maybe it's a concern, but I think we're gonna learn pretty soon what it's gonna be like.
And I wonder, I am no expert in this area, just disclaim, but when we look at technology and the regulatory landscape there and compare it to sustainability, the field is changing so quickly. Perhaps now is not quite yet the right time in terms of sustainability and M&A due diligence to have a firm regulatory framework in place. As things change and evolve and normalize, then that would be the more appropriate time.
And I guess just leading on from that one, another question from Nell in the audience. How do you manage acquisitions where different organisations report using different ESG frameworks, aligning history and forward planning? If anyone wants to jump in on that one before we go to the next poll.
Yeah, I'll give it a shot. I think the key word is going to be around interoperability. How do these different regulations overlap, interconnect? And once we identify what is the incremental gap to meet a supplementary or secondary regulation, that's where the attention usually needs to be applied. Developing a remediating action to address the gap and then implementing that. there has been a lot of, I'll take the ISSB, for example. They have flagged that it is highly interoperable with CSRD. There's also interoperability considerations in terms of GRI. And then you find that in the SEC's climate disclosure rule, they're pulling from the greenhouse gas protocol that has been around for decades, and they're also pulling from the TCFD. So you are finding jurisdictional regulators trying to develop standards that create a global baseline for sustainability reporting that are compatible, comparable, reliable. But to answer the question, a key point is just to assess what is the interoperability between the reporting requirements, understanding what the gaps are, and then remediating them.
And I guess
Great, thank you.
just using, sorry, Jason, but just going back to the days when we didn't have a global consistent set of financial reporting standards either, all the same issues applied then, which we've now addressed largely to be able to have that, or not comparability between different organizations. So, we're working towards getting there with this in the sustainability space as well.
Agree. And we might move on to the next poll now, if we could pull that one up, please. The question, and it appears on my screen. I do have the question written down, it's not appearing. But the question is, do you think you have the relevant skills to deal with sustainability in transactions? So hopefully you should see it on your screen now. Do you think you have the skills relevant to deal with sustainability in transactions? We're at 91% to 9%, moving slightly there, but it's an overwhelming no response for that one. Which leads me nicely into the next section, actually. It's now around people. And attracting talent into the profession is a topical issue across all our global chartered accounting bodies. I'd like to get some input, whether you see this in your organisation, and does sustainability further impact this? Perhaps I'll start with you, Sid.
Yeah, I mean, we've all seen, there's a shortage of accountants, right? Especially in the US, and I'm sure globally. People taking the CPA exam, etc., have gone down substantially. From us, we see a ton of openings for CFO and controllers and demand for that service as fractional controllers and CFOs are needed, right? So just with that lens on, I would say sustainability actually just increases the need for upskilling, right? That's one. Two, I think it generates significant more interest in the role, because it's not just the traditional bookkeeper like mentality. It's the wider, this is how we grew up doing the chartered accountants exams, right? It's the wider business profession. And so I think sustainability is only going to increase the importance and the demand of the role. And the shortage is not going to go away until more people engage with it, right? Engage into becoming, in the accounting profession. But at the same time, I think it provides a ton of opportunity for key professionals within organizations to step up and upskill and progress their careers. So for us, I think we see, from my firm, we have individuals at, let's call it the senior analyst to manager level, that are slowly starting to upskill, because they know that, hey, there's a business case that a lot of people, a lot of clients are needing this service. And so there's a partnership path or a career path that they could, even if they don't progress the partner, they can still go to industry and become a CFO of a sustainable fund, or a company investing in sustainable energy and things like that. So I feel like this is only a positive, but I think it's going to mean that more people have to step into that role, whether it's people already in the profession or people coming into the profession new.
Thanks, Ed. Charlotte, do you want to give some insights from the CA ANZ organisational point of view that you might see from the inside?
Look, absolutely. Thanks, Jason. Look, I would just say that it's a really quite an exciting and a scary time to be a chartered accountant. Well, not so much scary, but I mean, certainly as the other panelists have spoken to, there is a bit of a challenge for the profession in that it's not as attractive as it once was. So we're not getting the numbers of people through. I think if we look in Australia and New Zealand, the number of people graduating from that traditional accounting degree has halved over the past 5 years. So the pipeline isn't full as we'd like it to be. And where sustainability presents a really amazing opportunity is that it showcases the profession's commitment to addressing global challenges. And it really would resonate with young people eager to contribute to positive change and to have a role that's meaningful. So I think this is really going to help attract future talent to the profession. And then you think of jobs that didn't exist back in the day, maybe when I studied, that are starting to come to fruition now, such as, the CSO, such as working in sustainability assurance, carbon accounting, being an ESG controller, an ESG analyst, all those sorts of things. From an ethical perspective, an algorithm auditor, they're all really exciting roles and opportunities that will help attract people, young people and future accountants to the profession. So that's a pretty exciting time.
Absolutely. Go on, Prashant, if you want to add some stuff.
Yeah, I was just going to share, from my perspective, I have been part of that generation of accountants that graduated where people just expected, it's like, oh, an accounting degree or accounting, like you must be good with numbers. These are typically from people who work outside of finance, outside of the accounting teams. And I have thoroughly enjoyed being part of the narrative that I share with the next generation of folks that are going to college and universities and saying, well, being an accountant is no longer about numbers. It's actually much more complicated than that. It's about corporate accountability. And how do we make sure that we're presenting an accurate, complete representation, disclosures for the company? And then usually people will pick up their ears, be like, oh, I didn't really think about it like that. It's just like, yeah, like an accountant is not just here to do your taxes. We can really help drive value and really help inform some amazing internal reporting that drives some transformational change. But the only perspective I was going to share was I'm enjoying being part of this story and helping the next generation of accountants understand what it means to be an accountant isn't what it was even 5 years ago. It's changing.
And Prashant, just to add on to what you were saying when people sort of comment on numbers and all the rest, I think there's a sort of a growing field of people who would refer to, instead of the CFO or the chief financial officer, they would refer to them as the chief value officer, which I think more accurately encapsulates what it is they actually are doing, or if they're not, what they should be doing in their role.
Thank you. And just one more question from the audience I've seen come through. Just a question on whether you can highlight a few simple tools to adapt a sustainability approach for transactions in a medium-sized company. Perhaps if you want to start with this one, Prashant.
Yeah, there's a lot of tools that are coming out in the market, given the need for sustainability reporting and the need for accurate information. I've also been trying to understand and keep up with it, because as sustainability evolves quickly and you put technology as a topic in the middle of that, which in itself always evolves quickly, the growth potential in the movement is incredible. To answer the question, I have found a few simple things to be really important. One is, don't build a solution in a silo. Do it considering your current system architecture. Assess what the needs are in terms of what is the reporting platform that you currently have, and what is the direct route in order to get the data from system A into your reporting solution? How do you make sure that the way in which you're constructing your data trail is actually creating a very clear, robust audit trail? This is not going to be the same for every organization. The systems that we talk about today will be different from the systems that we'll talk about tomorrow. This is why I say there isn't a silver bullet. There isn't just one solution. Take a look at what you currently have. Consider what the gaps are in order to meet your reporting requirements, internal reporting, what is needed for your sustainability-related due diligence in the deal, and establish if there is a solution specifically to meet that need. Don't go to the market first and then try to assess how it matches what you need. It's the inverse. What is the gap? What is your need in order to take next steps?
Yeah, I can add to that, Jason. And I would say, look, I see from a private equity lens, I see a lot of, we call it roll-up strategies or add-on acquisition. So a private equity will make a platform acquisition, and then we'll add on, call it 10 companies per year that are small to medium sized. And then at the end of, let's say, call it 4 or 5 years, when they're ready to exit, they have this big platform investment at scale. And so when they're considering, you look at kind of the acquisitions of these medium-sized companies or small-sized companies, you do get a valuation that's lower, but that's expected because it's a smaller company, and they just don't have the capital sometimes to invest in ESG reporting or ESG like friendly practices, right? And so I think the opportunity really is on the private equity side to capture some of that value creation, because once they bolt on into the platform, they can use the platform as the base to then grow and kind of build the culture within the firm by bolting on the small to medium enterprises. Now, as a small to medium enterprise business owner, like that angle would be to be part of that, right? So have some rollover equity, have an earn out where you can earn a valuation that's higher than normal if you sold today versus leaving some equity in the business and be part of the growth. So yeah, hopefully that kind of helps answer the question.
That's great. Thank you, Sid. And we're very quickly running out of time. So I'm just going to give one last opportunity, 30 seconds for each panelist. What is the main message you would like the audience to take away with them tonight? And I'll start with you, Charlotte.
It will be no secret to anyone who's been listening to me, but it would be my message to you out there in the audience is lean into this. You indicated in the poll, most of you, that you don't feel equipped to deal with sustainability in M&A transactions, for example. Lean into it. It is your personal responsibility to upskill yourself sort of broadly and in the technical aspects you need to in order to be able to do this or your next role confidently and ethically. Thanks, Jason.
Thank you. Tashan, in 30 seconds.
Absolutely. In a nutshell, tying to how I opened, sustainability is no longer a nice to have. It adds value to the organization. There is an opportunity to unlock efficiencies and gain a competitive edge. Those that understand this and are leading today will be destined to lead in the future. So don't underestimate the power and the value of sustainability within your organization and embedding it within your operating model.
Thank you, Tashan. And Sid, I'll have to give you only 15.
Yeah, I'll say the same thing. Lean in, but think about things outside of just, the big picture items. It could be a social impact. So it could be something that you could focus on that's smaller. But yeah, thank you so much.
Thank you. And a special thanks to our panelists tonight, Charlotte, Tashan, and Sid. And thank you to the audience for their questions. On that, I'll pass back to you, David.
Thank you, Jason. And also thank you to our presenters, attendees, and Chartered Accountants Australia and New Zealand. Before you exit, please fill in the feedback survey available on screen. Filling in the survey also counts as the final poll for the event in case you may have missed one earlier. As stated at the outset, we will be following up in 10 days with digital badges for attendees who registered for it and CP certificates for members who are also US CPAs and have qualified by answering our polls. We'd also like to highlight our next two events. Firstly, Beyond Accounting, AI and Accountants Get Real on May the 30th at noon Eastern. And secondly, our annual conference. Tashan, you'll like this, as it's titled Beyond Accounting, Not Just the Numbers, in New York on June the 13th. And with that, thank you. And for now, goodbye.